Well, good afternoon, everybody. Here we are, just 6 or 7 minutes away from our start time at 12 o'clock. Simon Campbell here. I'm your host for the next couple of hours for this Round the Clock Trader working lunch event. Just to start, welcoming those quite a lot in the room already, which is great. Can you just confirm that you are hearing my voice? And you should be able to see a blue screen at the moment that says working lunch on it. You just use the chat box to say that's great. Oh, fantastic, great. Okay, yes, everybody's hearing and seeing so far, which is great. So welcome, everybody. Carolyn, hello there. Hi, Kapil, Jonathan, Guy, fantastic. Yes, we'll start with a question from Guy. Is this going to be an inquisitional session or more for trading style? I will be drilling the speakers a little bit, but very gently, Guy. This is more about three really presentations independently. Each of the speakers have got something to say about the current markets, their own strategies, systems that they're using at the moment, but it will be an opportunity to post some live questions to them, ask them about any particular stocks or markets that you're maybe interested in, want them to analyze. So a little bit of both, I think, is the sort of the cop-out answer to that. But it's not just a chat. It's not just an interview in a chat. They will have some slides, and we'll be looking at their screens and looking at their platforms and see what they're trading at the moment. So I hope that gives you a better picture of what lies ahead. So what does lie ahead are three great speakers. I know them all quite well. They've spoken at many of these events that I've done, webinars and these live trading events that we have in London from time to time as well. So of course I've known Alpesh and Charlie Burton, both known them for 20 years or so. We've been in the same business together for quite a long time, offering good quality trading education. And this is really what Round the Clock Trader is all about. It's all about being able to provide a filter for you to meet good quality trading educators and commentators, so that you can hopefully stay clear of the slightly seedier side of the forex trading industry, which is populated by people advertising courses and Ferraris and all that sort of stuff, which of course most of us here know is pipe dream stuff. But we're all about the real, and we're all about just trying to use trading as a serious tool for taking money out of the markets on that sort of consistent basis, and looking for realistic returns and realistic strategies that allow you to do that. And all three of our speakers today do that themselves. So first of all, Charlie Burton, he's going to be the founder of Easy Trader, which is a business offering live trading rooms and daily analysis to not just the retail market, but also to the institutions as well. Then at 12:30, Jay Lakhani is the founder of Bindal FX. Jay, again, a trading mentor himself, very much a fan of Fibonacci levels, his website, fib123.com. And then, of course, Alpesh Patel, who perhaps doesn't need much introduction, Alpesh being a regular commentator on the markets, invited onto BBC Breakfast many times. If you're up early enough to see the breakfast, the BBC Breakfast at 5 a.m., Alpesh is on there normally most weeks. He's also a fund manager, has his own hedge fund, and of course does his own educational packages as well, keeping retail traders on the right lines. So all three fabulous speakers, and we will be first going over to Charlie Burton at Easy Trader. Now I can see that Charlie's in the room, which is great. Just before we do that, we will just like to say that the registrations for today are quite high. So if you do need to leave for anything, if you're wanting to pop away for 5 or 10 minutes, do just stay logged in to the webinar, because I think we are going to hit that capacity attendance, and if you log out, and you might not be able to get back in. So just a little tip there. I think it won't be long before I have to increase the capacity of the webinar room again, which is all, of course, good news. So hi Gordon, welcome there. Just about to have a thunderstorm here. And subsequently maybe power loss. Gordon, you are on the other side of the world, I think, if I remember correctly. But coincidentally, we're having a thunderstorm here currently as well in Spain. So there we are, thunderstorm in Asia, thunderstorm in Spain. I know that Milan last night, my colleague at Fineco Bank, they were having thunderstorms there. So everywhere thunderstorms except for the UK, which I believe has much nicer weather. So providing hopefully the rain. That was Jonathan. Manchester's glorious sunshine in Manchester. Great, Jonathan, fantastic. Okay, well, thank you. And those of you listening to me rambling on and you're just checking in, wondering what on earth is going on, my name is Simon Campbell. I'm the host for today's 2-hour webinar show called Working Lunch. It's a round-the-clock trader event, and I'm pleased to have 3 excellent speakers joining me to take us through some presentations, some trading presentations, looking predominantly at swing and day trading strategies, a little bit looking at the live markets and some techniques that we can use to win in these sort of volatile markets. So Charlie's already in the room, and I'm going to go across to him right now and bring his microphone on. This is what happens when everybody's logging at the same time. It's a little list of attendees. It jumps up and down crazily. So okay, sorry, a few buttons that you can click there, but we should be live now with Charlie. So
you are indeed.
Good afternoon, Charlie.
Good afternoon.
Oh, fantastic! The big booming voice comes out the speaker. How are you?
I'm good. I was just chuckling to myself when you said that you've been having thunderstorms and lots of places have been having thunderstorms, but not in the UK. Yeah, you need warm weather for that, Simon. You know, that's hence why you'll get it. We're not.
Well, it's been very odd. As you know, I've been locked down here in Spain for the last 2 months with this virus pandemic, which we're all aware of. And to go with the surreal lockdown has been the surreal weather as well. So I think we've had more rainy days than sunny. So it adds to the weird atmosphere. But anyway, I'm glad you're getting some sunshine and some freedom back in the UK as well. So must be making a nice return to normality of some description.
Well, Simon, I remember we were speaking. I spoke to, was it early this week, wasn't it, or was it in the last week? End of last week.
It was.
And you were saying about this return to some form of normality, and I was laughing with you because I said, well, this is my normality anyway. There's not much different to my normal life because I sit at home in my office, walk the dog. There's not a huge amount going on Monday to Friday anyway, so it's fairly normal for me.
It's very true. I know, I'm largely there. I suppose the biggest difference is that we've got the children at home through the days, so that brings on a little bit of extra complications. Listen, it's great to have you here, Charlie. Thank you for coming back to join us again. I know we've got a special event coming up on Sunday that we're going to talk about towards the end, but I wanted you to come on and because it's been a while since we had you on this show, and I wanted to find out how you've been getting through the markets the last few weeks. Obviously been very strange times for traders, and just to sort of update us on that. So shall we go across to your screen so we don't waste too much time, because I know that you've got all sorts of things going on today as well, so this was great for you to squeeze us in. I'm going to make you the presenter, and we should now go across to your screen.
Yeah, I'm just getting the right screen. Which screen is it? It's that one there. Is that the presentation slide?
That is it. That is it. Fantastic. A simple
Good.
trading tool with Charlie Burton. So can
Okay.
everybody else see that as well? Should be looking at the white Easy Trader slide at the moment. Yes, fantastic. Great. Well
I didn't
done.
know
Great.
which way you wanted to do this, Simon. Do you want me to run through this? What I did is I put together a short presentation for your members here. Did you want me to do that? And then actually, I'll do that because I haven't got a clue how long it'll take me to go through this. So this might actually be.
Okay.
I'll just go through this. And we can have a
Well,
chat at
we've
the end.
got about 30 minutes or so. So let's see
Oh,
how we
okay.
get on, and we'll take some questions at the end if time allows.
Yeah.
But let's just get straight to it, Charlie.
Yeah, and within this presentation, I'll flick over to. It's only a few slides. I didn't want to make a lengthy presentation as we discussed previously. But within this, I will switch over to some live charts as well, so we can have a look at some examples and see what's going on in the markets as well. So I will do that as well.
Wonderful. That would be fantastic. Hand over to you.
Thanks, Simon. And so, yeah, when Simon asked me if I would do a slot for him, and we really couldn't get much time because I've got to shoot off today. But I thought, oh, what can I present on? And I thought, well, when you've only got 15, 20 minutes to do a presentation, you can't really go into too much detail, but you can offer some things. And I thought, well, when I spoke to Simon, what have I been doing lately within these markets which I could sort of give to people who are attending here today? And so I thought, well, I'm going to give them a simple trading tool. So I'm going to show you a tool that I use. It's just an indicator that I use and how I go about using it in these markets. So I'm going to go through a few slides with you, then we'll go on to some live charts, and we can actually just look through some live charts as well and see how that indicator is moving around with the charts live right now. So that's what I decided to do. So let's go and have a little look. So this tool came as a result. Oh, originally this tool was, I put this together as to create an exit strategy. So if I bring a pen up, what I was doing this, I mean, I've been using this for years and years, this tool, but if you had a market which was in a really nice run, so sometimes I'd get into what I call a momentum move, where the market just keeps going really strong and hard, especially on like a 5-minute chart. So this was, don't get me wrong, I use this tool for swing trading or day trading. But back when I first devised it, I wanted to find an exit, a nice enough exit when a price is having a strong, hard run, like on a 5-minute chart, you'd get these strong runs. But as many of you know, just as quickly, they can then come off as well. And if you're trying to maintain your profits, and at what point do you exit? So back in the day, I was experimenting with a stop management tool, or looking for a stop management. I'd looked at all these different general indicators that you can get on your charts, which pop little dots on your charts and all sorts of things like that. But none of them seem to really work for me. So, and if you just use a broker's automatic trailing stop tool, I think they're a bit crude. So I was playing around with this, and because I use a lot of moving averages in my trading, I thought, well, maybe I could put together a short-term moving average, and then when price closes back below that, then that's my exit tool. So again, if I draw this on, and then if I just crudely draw this on, let's say I've got a moving average like this, and as soon as price closes below that moving average, that could be my exit. And so this is how this came about originally. And then it's just a case of, well, what type of moving average do I want to use? And it's all very well when the markets are moving up, but what if I'm trading in a market which is moving down? Do I want to have a different moving average when price is moving down? So because price might be it might be more like this, the moving average, and then I'm looking for a price close above it. So this was, like I said, I don't know, 10 years ago, I started experimenting around with this. And it was a funny thing, because how I originally looked at using this tool has morphed into me using it in many different ways. And so I'm going to show you just just 2 or 3 of those ways that I use it to this very day. So let's move on. It's simple, and as I've just said, it can be used in many ways. So as a trade exit tool, and there's a couple of different ways I can use it for exiting trades, but also for getting into trades as well. And so I'll show you that as well. So all we need to do is add 2 moving averages onto a chart. So before I actually go to what those are, what I did back in the day is when we got a price moving up like this, I wanted to have a moving average which was going to be quite close to price. But what I ended up doing is, because you're also going to have prices where it's going down, and then you're going to have this moving average like this as well. So I ended up putting 2 moving averages on, one that really caters for when price was moving up and one for when price was moving down. Okay, so I'll explain more. So I put a 5 exponential moving average based on the high price, and then a 5 exponential moving average based on the low price. So what that actually did is, drawing this back on again, this whole price sequence, is that it created a moving average which would usually be just below price when price is having that strong run up, and there would be the 5 EMA, which is based on the low here. So here's your 5 based on the high, 5 EMA, and then here's your 5 EMA based on the low. So once price closed back below the 5 EMA based on the high, I could use that as an aggressive exit. But sometimes the market isn't quite as aggressively moving as that. It's not always having those outright momentum moves. So this is why I wanted the 5 based on the low as well, so that I could, in actual fact, give it a trade a little bit more room. If I was trying to run it a little bit more, then I'd say, okay, well, I'll wait for a price to close below the 5 EMA, the lower 5 EMA, and then I'll use that as my exit for a different type of trade. So I've got 2 different exit tools there, and hence why I decided to put 2 5 EMAs on a chart. It's the only time I ever use an EMA, actually, exponential, but one based on the high price, one based on the low. Now, normally when you put a moving average onto a chart, it's based on the closing price. It automatically will default to the close price. So what you would actually do is, when you go to put a moving average on a chart, you actually change the default settings. Let me show you. Here you go. So this is on my charting software. I use eSignal, but it doesn't matter what platform you use. The majority of platforms, even free charting software, you will be able to do this. So as you can see, I've put in here, if I bring my pen back up, I've got a 5-period moving average, exponential, so an EMA, and price source. Now, your charts might not call it price source. They might just call it whatever, I don't know. But normally this would default to the closing price. It would normally say based on close. All you need to do is hit your drop down box and it'll give you some options. And so we want one of these 5 EMAs, pop it on, set it to the high, and then do the same thing again. I go to the next slide and you change it. And then so you already put the 1 moving average on, then you put the 2nd moving average on, set to the low. And then, hey, voila, this is like a cooking program, and say, look, and here's one I've prepared for you earlier. So here's now a chart with those moving averages on. So we've got the price, the moving average based on the high, which will be the higher one of the 2, and you've got the one based on the low. And what you see, and this is what, although I'd first devised this to help me with exiting trades, what I started to see was, once I was using it for a period of time, was how many other ways I could use it as well, and we're going to go through that. But first of all, what I'd be looking for, like I said, is these momentum moves. If I get into a momentum move where price is moving up aggressively, so how I can actually tell that price is moving aggressively is if it's closing on the outside of the upper, if it's going up, of the upper 5 EMA. So like in this period here, we can see that price, after, it's not just on one candle, but 3 candles in a row is the minimum criteria, that it's closed on the outside of the upper EMA. So these 3 candles here, it's closed on the outside of the upper EMA. That's again telling me, okay, we're in a nice strong move here, and we can see that it carried on and it did what, 5 candles in a row there, closing strongly on the outside of the exponential moving average. Now, if I wasn't using an aggressive exit strategy, you can see that actually price actually had a fairly strong deep pullback. Now it ultimately went higher, but again, it depends on your trade timeframes, how aggressive you want to be as a trader. A lot of traders out there want to get in, they want to have an exit strategy which gets them out as well, and they don't have to sit through pullbacks and all of that. So, and for some of my strategies, that's what I used to do. And so where we are, we've had a nice run up. We've got a close back below that upper 5 EMA. Right, there's my exit. It went a little bit higher and then came off. So that's just an example. I've just taken this as a screenshot when I just put these slides together yesterday. And so that's just one example of that. But what you start to see is when price does start closing for 2 or 3 candles in a row, like back here as well, on the outside of the moving average, then it tends to be that there's going to be some more follow through that. So you start to see these patterns appear where you're getting bars closing on the outside of these moving averages. It's telling us that the trend is strong at that moment. On that time frame, the trend is pretty strong when you're getting that sort of sequence. Now you will get candles like this where you get a singular candle, like this big strong green candle here, closing on the outside, and then it immediately starts to retrace. But quite often as well, that's just a retracement before it then starts to meander its way back up again. So there's all sorts going on a chart like this, with just looking at how price is with these short-term moving averages and saying, wow, I can use this when I'm looking for an aggressive exit. If I'm long in something, okay, I can use the leading moving average. If I want to wait and give it a little bit more room, like here, and okay, well, I'll wait until it closes below the lower moving average, which would have had you out at a worse price, of course, but it might have meant that you could carry on in the trade, a bit like over here. Look, through this, we've been going up, up, up. It never closed below this lower moving average, and yet, so in this situation, it's more of an undulating move higher. Then we've had an aggressive move, look, where we've had 3 strong closes on the outside of the bands, and then you could say, right, now we've closed back inside the upper moving average there. Now I'll use that as my exit there. But ultimately, it still didn't close below the lower one. So there's so many different ways that you can use this. And I'm a big believer in traders taking something. It's what I always do. And then I just play with it for months. I'll just keep it and for months. And that's what happened with this. It started out as an exit tool, and then it's become and it's morphed into others. And I'm going to show you how else I use it in a moment. So that's the first way that I used it. Okay, let's now have a look at another chart now. Now I'm going to show you some examples of how actually you can use these 2 moving averages for getting you into trades as well. So we've got an example here, and I took this is an example literally on the euro dollar from yesterday, where the euro dollar has done a double top here. Okay, so it did this yesterday afternoon, spiked up initially. I think it was when Jerome Powell was speaking yesterday afternoon, but effectively it got rejected there. And then what did it do? It closed back below the upper moving average here of the two fives. So we know that it's done a double top. Lots of traders like trading double tops, double bottoms. In fact, it was almost like a triple top if you include the prior highs from over here as well. And a nice reversal type candle there, which should mean that by itself that you get some follow through. But what I always do if I'm trading a double top or a double bottom is I wait for that close back inside my 2 moving averages. And if I wait for it to come, it gives me more of a confirmation. I also then know where to place my stop loss, which can then be above the high, above the reversal high. So it's a really useful tool for getting you into trades as well, let alone just for using as a stop management tool. So the more you look at it and the more you see, oh, look, through this period here, look, strong, really closing strong on the outside of the bands, closes inside the bands. Okay, use that as an exit tool, sort of thing. So there's so many different ways that you can use it, but that's an example from euro dollar just from yesterday afternoon. And now if I don't want to just show intraday charts. So I'm going to now show you a euro dollar chart. Then we're going to go on to some live charts in just a moment. So looking at this monthly chart of the euro, I took this screenshot just this morning, actually. I went out for a run and just added a couple of extra slides to this presentation. And this is this big triangle pattern that we've had in play for years now, when you look at a monthly chart here. But again, you start noticing little things. So back here in early 2017, when everyone was talking, I was being interviewed on TV back in early 2017, and the interviewer was saying, Charlie, we all agree that euro is going to go down to parity now. It's so obvious, isn't it, Charlie, sort of thing. And that was the questioning that I was getting. And yet I was actually going long because we just made a marginal new low, but then, so effectively a double bottom, closed back up inside my two moving averages. So it was in this zone in January of 2017 that actually I was getting long because I had a confirmed double bottom, closed inside here, stop loss below the low type stuff. That actually became my biggest trade of the year, that euro dollar that year. But that was, there was other things going on. It's not just based on using those two moving averages, but they give me the heads up to get into a trade. Here's another trade that I took with my swing traders in 2018. So when the euro got all the way up to the upper trend line, and also it was into these prior lows, myself and my swing traders, we got short up here. Now, we didn't get in right up here. You wait for price to close back inside the moving averages. Then you can then put the stop above the high, and then you've got a trade. Shame we didn't run it all the way down, but it still ended up being a nice trade on the weekly charts. But it's using that and not just trading it right against a resistance zone, which you can do, but then you've got to work out your stop. So I rather wait for price to then close back inside these two moving averages, and then I know where to place my stop. And at least I've got a bit more confirmation that we are actually having a reaction to that resistance zone there. So really, really simple trading tool I'm giving you here today, which I use in many, many applications. So the other application that I use it on is for, if I go back actually, maybe it's gonna go back, is for when, I think I've already hinted at it, but when price closes on the outside of, if it's a short, the leading edge of the moving average, like down here, if we get a strong downside bar closing near its lows or closing near its highs, if it's an up bar, then again, it usually means that there's going to be follow through to that. So I use a couple of other tools with that, but again, it's giving me, using those moving averages, giving me a heads up that something's going on here. We've got a strong candle to the downside. Usually my momentum indicators are probably rolling in the direction of that as well. Great, okay, I can trade that on the downside. So there's lots of different ways. I've just given you 3 ways there, at least 3 ways of using this. There's a stop management tool, and there's a couple of different ways within that for things like double tops, double bottoms, or just or like even on that monthly chart as an entry tool for off of some price coming up to a resistance point or down to a support point. So you don't have to sort of jump in. You can sort of wait for that sort of confirmation before then jumping in, or before getting in. So there you go. So there's a few different examples there. Plus also, like I've said, when you get strong up bar, closing on the outside of the bands, normally, I call them bands half the time, closing on the outside of the moving averages normally means that it's going to be follow through to a strong up bar or follow through to a strong down bar. You can see that actually the euro dollar through all of this has just been, it's not managed to get a single close on the outside of the upper moving average. So it's just sort of meandered its way lower, but we haven't had a single close on the upside as yet. We got up just a couple of months ago. We thought we were going to get a close, but it came all the way back down and closed back within. And this is literally a screenshot taken this morning. So we're still sitting down here in this overall move at the moment, even though the overall move has been a bit messy there. Anyway, let's move on. Then we'll go to the live charts. So as I've already said, can be used as a stop management tool. There's a couple of different ways you can use it as a stop management tool. And don't get me wrong, it doesn't have to be used aggressively on a 5-minute chart. You can still use it aggressively even if you're in a swing trade. I'm in a gold trade at the moment. I'm going to show you the gold chart and how I could use it as a stop management tool on that trade in gold. So I'll show you that in a moment. Used combined with support and resistance reversals, as I've already said. And for trend trades after it closes on the outside of the leading moving average. I do have some other ways I use it as well, but I'm giving you 3 there, which I'm sure will be enough for you for today. So let's now go to some live charts. Simon, I'm still okay for time, aren't I? Got 5 or 10 minutes?
Yes, absolutely, Charlie. And we've just got a few questions, but let's
okay.
have a look at the live chart. Then maybe just at the end we can do that.
Well,
Sure thing, thanks.
This is funny actually. Look at this euro dollar. Look, oh, this is brilliant because I shorted the euro dollar about half an hour before I came onto this call here today. So let me just take a screenshot. See if I can get a screenshot of it. It's just a screenshot of my account here. See if I can grab it. Now I'm doing all this live, trying to get a screenshot of just the euro dollar trade. Oops, now I've clicked on Google. No, I don't Google, I want the snipping tool. Okay, so I'll quickly snip this euro dollar trade. Okay, now I shorted that, like I said, about I don't know, half an hour or whatever ago before we started this. I've only put a 1 lot trade in, but you can see I'm already up 100 and what's that, 110 pounds, so to speak, at the moment. And you think, oh, that's not a lot, but yeah. On this account, this is actually the account that I use with the guys in my trading room. But you know, there's all sorts of trades on there. Like I've just taken another screenshot just before we started. This is an S&P trade that I took just a couple of days ago, and I'm sitting on nearly £2,000 in profit on that one. So it depends on the trade, of course. But anyway, here's a great example. This is an hourly chart. The euro closed on the outside of the band, the lower moving average down here, and we're already seeing that follow through. And of course, I'm going to be targeting these lows down here. So that's that. But what I wanted to do is actually come out to some daily charts of, firstly, let's go and look at gold, and then we're going to look at the S&P as well. Now, many of you, I'm sure, are watching gold intently because it's been consolidating. It's sort of building its way up within this pennant type pattern. So if I put my pen up, then it's in like a pennant pattern here, which is normally a bullish sign. If it comes after an up run, it's normally a bullish sign for a market. But it doesn't mean to say that it will just break and then keep going, but that's normally the case. Now, with my swing traders, we got long on gold here at 1590 after this initial pull moved up, then it pulled back. So we've been long since 1590. Now, as you can see, using these moving averages, if I'd have wanted to have been really aggressive on that trade, by the time it came up here, closed on the outside of the moving average here, it was only a 1 bar though. So really, I'd be really aggressive if I waited and came out at the close there. If I wanted to be, I could do. Otherwise, it's only 1 bar. Look, by the time we've got up here, look, 1, 2, 3 bars. Now we've got 3 candles in a row, which is the minimum criteria for a momentum move. Then we've closed back inside the 2 moving averages. Right, that could have been an exit there. Now, I didn't exit there. I'm still sat in this trade with my swing traders because we're trading a bigger move on gold right now. But again, you're seeing how you could use these 2 moving averages. So gold at the moment, again though, if it breaks up in the coming weeks, then I could well be using these bands as my exit, as these 2 moving averages as my exit strategy. If we get a bit of a breakup and we have another strong run, a bit like that strong run on the downside there, I could use that as my exit. S&P, let's go to the S&P. Now, the S&P, look what's happened just yesterday. So we sold off 2 days ago. Look at yesterday. Now, as I've already said, already shorted the S&P anyway, but we closed on the outside of the lower moving average just yesterday. So I would expect generally more weakness to come in. So now it wasn't the strongest close, admittedly, in that we didn't close right down near its lows, but it was still a decent down day for the S&P. So generally speaking, I'd be looking for more weakness to come in. And so again, and if I go to maybe to an hourly chart, just to put all that into context, then you're like, oh wow, look how it sold off. It did a sort of a key reversal type candle, a bearish engulfing candle up here. Then we got the big sell-off bar here, closing on the outside of the lower moving average, and then we've got follow through, done a retrace, and then bosh, here we go again. So there we go. It's a simple tool. I better not go on too long because I said that I don't. We've only got about half an hour or so. We've got time to take questions, but I'm also conscious that Jay's going to be on next, and I don't want to take too much of his time. So there you go. There's the live charts there, just going through a couple more examples. So from one tool, just 2 simple moving averages, you can get an idea for how they can be used. Now I'm just going to mention a couple of other things. Okay, oh yes. This coming Sunday, Kim and I, my partner at Easy Trader, we are doing an all-day Zoom course. It was going to be a live course in London. Simon, you were going to come and attend. We were going to do it. We'd already booked a hotel in Heathrow, but that was obviously prior to the virus spreading around the world. And so we decided, look, we're still going to do it, but we'll do it online. And so we're going to use Zoom so that attendees can see us as we're presenting. And it's a full-day course where we're going to be presenting. Kim's going to be presenting a strategy. I'm presenting quite a long strategy. Plus, I'm going to be going through a trader mindset session as well. So it's a really full-on, really nice day, but you can attend from the comfort of your own home. All you got to do is log in, a bit like you're logging in here. If anyone's interested in doing it, then it's only £77 for the day. So if you want to do it, there you go, it's £77, and there's a link. Just go to easytrader.com. It's not an easy link there, is it? But /live-trader-training-day. Sorry about that, but hopefully Simon can put the link somewhere. But so we're only doing it on Sunday. A lot of us are at home anyway, and so if you want to come along, it's only £77 for the entire day. You can provide your own coffees on this occasion, but there you go. That's what we've got coming up just this Sunday, and I'll be using those 2 EMAs during that course. But obviously, there's a lot more detail in that course, even that I've already given you here today. So if you're interested and you think, well, actually, get to learn a couple of strategies. It's funny, actually, Simon. When I came and did last time I saw you, Simon, we did a presentation live at Finaco's offices, and do you remember, Simon?
That's right, back in January, or was it February? Maybe January, February.
Yeah, and I'm just going to take us back to the live charts because I've just remembered. You probably won't remember, Simon, but I literally, when I gave that presentation, I showed people why I'd got short the S&P, and it was right over here somewhere. And I said to them, look, you can get in short now. I literally had got short that day, and look what happened next. Only shame was I didn't hold it all that way down, but we did have a good run on it. But I keep forgetting to mention it to you, Simon. That day, that afternoon, I gave that presentation, and it was that technique that I'm going to be showing this Sunday. So the technique that got me into that S&P trade there is the same technique that got me into this £2,000 profit trade at the moment on that account that I just showed earlier on. It's that same technique that I'm going to be demonstrating this coming Sunday.
Absolutely fantastic, Charlie. I know we're just running out of time, but quickly, there's a question on the timings for Sunday. What are the times? Could you just remind us?
Yeah, it starts at 9 a.m. UK time. and we're running through till about 3 o'clock ish. So I said it's a full day, but it's, you know, that's full enough. So we're running through till about 3 o'clock ish on the Sunday afternoon. It might mean we run to 3:30 or 4, but yeah, between 3 and 4 is the intention, to try and get it wrapped up for everybody. So we're starting at 9 a.m. We will be giving people breaks as if they were with us live. So we will have little short, 15-minute breaks, so people can go and have a cup of tea or whatever, and there will be a time for people to have a lunch break as well. But it's going to be a packed day over that period of presentations. So there you go, 9 till about 3 or 4 o'clock in the afternoon with breaks.
Yeah, and Paul's asking, will they get a copy of the recording afterwards?
What, of that day?
Of the event, yeah.
We want people to attend. So if they can't attend, unless they're somewhere else around the world, that's fine. But we want them to attend. So I don't know if there'll be a recording of the day available. We want people as if they were coming to Heathrow, and they were going to be sat there. We want them to be there rather than sitting there and just watching the recording, because most people, when it comes to watching a recording, they never watch it in the same way as they will do if they're in attendance. So we're trying to encourage people to actually turn up.
Absolutely fantastic. It's going to be a great day.
Yeah, it's going to be good.
Well, I'm sad that I'm not getting a trip to London out of it, but there we are. we'll have to do it online
next time,
as we all have to do these days. Wasn't fantastic. Robert saying, what about takeaway notes, anything like that? Will be available. I guess if more questions on this particularly, maybe Sam's the best one to ask. But
yeah, by all means, if they go onto our website, if you go to that link that I've put up, if they go to that link, they can read more about the day by going to that link. And if they've got any questions, then they can always email Sam at easytrader.com, and she'll deal with any other questions. But what we want it to be is, like, as much as we can make it, like a live day with people sat there. They can engage with us, ask questions as we're going along, all of that type of stuff. Like I said, they're going to be able to see us as well as we're going through the presentation material. But we do encourage people to make notes. There's no better way of learning than if you're sat there making notes as well. So I do want people making notes, because there's going to be a lot of information, and I want people to make the notes. So it's really important. So it's going to be a great day.
Oh, it will be a great day. I'm really looking forward to it. Charlie, you and Kim always provide fantastic day. So I mean, that afternoon that we had in London was terrific, and again, you'll have even more time on Sunday to do this. So looking forward to it.
Yeah.
Great, thank you. We'll have to round it up there, I'm afraid, because I know you've got stuff to do, and we've got another speaker as well. So, but my thanks to Charlie Burton. Thank you, Charlie, for coming and speaking to us today. Very good.
My pleasure. My pleasure.
Already on the chat box. So I'll take the presenter role back from you, and good luck. Good luck on Sunday. I think it's going to be a great day.
I will do. Thanks ever so much for always inviting us on, Simon. It's always very kind of you to invite us on as well. And yeah, I'll make sure I don't shut the whole system down when I leave.
I wasn't going to say a word. Take care, Charlie.
Take care for now. Bye-bye.
Thank you again. Love it. Bye-bye. Okay, my thanks to Charlie there. Again, I always like the way Charlie zeroes in on what's one or maybe two indicators and makes it easy to digest, instead of trying to tell you the whole picture, the whole story of how to trade. One or two simple lessons can often make a big difference, and that's what Charlie does. So yeah, good luck on Sunday. If you choose to go ahead, it's a great opportunity for a very small outlay to spend a whole day with the guys at Easy Trader. So I think you'll pick up a lot of good information there. We are moving on. We have got our second speaker of today, Jay Lakhani from Bindal FX. Jay, I think you're there on the line, and I'm sorry to keep you waiting. We ran over there by 5 or 6 minutes.
No worries. Hi, Simon. Hello, everyone. Good afternoon. Can you all hear me?
We can hear you. Thank you very much indeed. So we'll go right across to your screen, if that's all right. I know you've probably got some people here that have seen you before, and probably some people that maybe seen you on an around the clock event or your own events. But just by way of a quick introduction, before we can just get straight into it, Jay, I know you've come from an accountancy background, moving into becoming a private investor and trader, and then leaving the corporate world, I think 20, maybe longer ago than that, and now a full-time trader, but also offering your services to other people looking to learn how to trade. So you have I think a private trading room and offer mentoring as well. So today we're looking at a bit of live trading and chart analysis, as we can see. Just before we get started, can everybody see the new slideshow on Jay's screen? It should say live trading and chart analysis. If we can just use that chat box to let me know that you can hear and see. Okay, fantastic. Oh, great, Roger, Bill, thank you. Okay, so Jay, how have you been, and how's the trading been?
Yeah, I mean, it's life as usual. I would say last 2-3 months has been the busiest ever I've actually experienced for a long time. So nothing has changed. Lots and lots of opportunities, lots of volatility. So I'll do cover some of those in the chart analysis later on today. And yeah, if you do spot any opportunities, we'll take a live trade. So yeah, it's business as usual. The only thing I guess I'm missing out on is my badminton and seeing the family. So that's the only thing. But apart from that, trading has been fantastic. Yes.
Trading is one of the things that has prospered. I think in this lockdown, it's become, everything's been put into sharp focus, that it's a great opportunity to sit at home and make a bit of extra money. So this is playing into certainly our hands, and it's great to see so many people coming onto these webinars again. So, well, where should we get started? So we want to get right into it.
Brilliant. Okay, Simon, thanks a lot for inviting me, and hello everyone. I hope you guys are doing well and keeping safe. Just quickly before I jump into my presentation, I've got a free webinar this Saturday if anybody is interested. It's mainly on trader psychology and mental fitness. So 16th of May at 3 p.m. Secondly, I've got a 7-hour, a whole day live trading webinar, which is next week, 20th of May, starting at 7:30 a.m. till the US market close. And all day long, as I say, you will be watching us trade real account, real money. So that's the link. And then thirdly, we got a live in person, a whole day live trading. So this is not training, but mostly live trading. So obviously, whilst you're watching us trade live all day long from the European market open till European market close. Okay, so those are the dates if anybody are interested. As I said, next week, do come and join us for a 7-hour live trading marathon. The cost is just £10 to attend. Okay. Couple of things I wanted to focus on today is A, trader psychology, and B, some live chart analysis. Why do traders fail? Okay, this is a perfect example. When the US oil, the market crashed, on that day in the morning, 92% of retail traders were long, right? 92%. And in my trading room, I was saying to my members, sell, 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 sell. This is not the time to be brave or catch a falling knife, but to follow the price action, to be disciplined, and to follow the system. Obviously, one of the reasons, or quite a few of the reasons why traders fail, is because they have this gambling mindset. They do not treat it as a business. Yeah. They have unrealistic expectation. They could go to a weekend seminar or a webinar, and Monday morning, they're all ready to do an open heart surgery. It doesn't work that way. You see, to become a doctor requires many years of experience and training. To become an accountant is the same thing. To become a solicitor is the same thing. You need to sweat it out. You need to have that experience behind you. And once you have that, then trading becomes a child's play, which is really the title of my book, Forex Mastery, a Child's Play. Despite that, 90% or thereabouts traders lose money. They don't have a trading plan. Okay, if they do have a trading plan, they don't follow it with discipline. Often, retail traders are trying to outsmart the market. Okay, they see the prices plunging down, and here they say, wow, this is sale time. Buy one, get 10 free. No, it doesn't work that way, right? If the system's telling you sell it. As simple as that. The market is always right. Okay, the market is always right. You need to follow the price action. Okay, another reason why retail traders fail is they snatch the profit, right? A small profit, they snatch it, and then they're trying to reverse the positions, quick in and out, in and out, in and out. Who's getting rich? The broker's getting rich, isn't it? Letting the winners run is the way you are going to make a lot of money. Yeah, retail traders tend to add to a losing position. What do pro traders do? Right? They go short here, they add, they keep adding to a winning position. Whereas retail traders often tend to add to a losing position. Also, it is very important to sharpen the saw, sharpen the tools. How can you do that? By doing a trading journal. As I often have said in my tutorials, you are the biggest mentor, you. Okay? How can you do that? How can you learn? How can you sharpen the saw? By doing a trading journal, looking at what went right, what can I do differently? Yeah. Guys, let me tell you one thing. There are no secrets out there. There are no holy grail out there. Let me tell you one thing. Nobody is hiding anything from you. No. No, the broker is not to blame if you lose. No, nobody is gunning for your stops. If your stops get gunned, you got to look at your trading plan. Was my entry correct? Did I get in at the right time? Yeah, you may well have a good trading system, but that does not necessarily mean that you will succeed. To succeed, yes, you got to be at the right place at the right time, but most importantly, you got to be the right person. Who am I? The self-study. And when you have that, you know what? There is no way, absolutely no way you can fail in the markets. Then trading becomes a child's play. Okay, so just quick background as to why a lot of traders lose money. Here I'm just showing very briefly a Bindle FX trading system. So easy to follow, right? When all the bars here are red, you're looking to sell. When the trigger line is red, you're looking to sell. When the trigger line is green, you're looking to buy. Our golden rule is no signal, no trade, as simple as that. Also, what we do in our live trade room, every morning, Tuesday to Thursday, we have a live trading webinar, okay? No training, because all the training's done prior to you attending the live trading session. What we're doing is real trades, real money trades, And after the webinar finishes, right throughout the day, what we're doing is we're doing a live trade broadcast. So basically telling you of what to do, when to do, how to do, the watch list, which goes into our trading plan. Again, this is a good example. Telling people euro Aussie dollar, get ready to pounce, right? And then we're taking that trade, and that was a massive, massive, massive winner there. Okay, at Bindle FX, very briefly, we got trading mastery indicators. We do the live trading broadcast with trade setups, live trading seminars, but most importantly, we focus on trader psychology and mental fitness on a one-to-one. As I mentioned earlier on, there are no secrets out there. Yeah. If you fail, it's you. If you fail, it's your mental fitness. If you fail, it's your psychology. It's your emotions, unable to control your emotions. Yeah. You know what? You could easily trade using a chart, nothing on the chart, with just, let's say, a moving average, say for example a 200-day or 200 period moving average, and then focusing on a Fibonacci 1 to 3. You know what? 40% of the trades will be winners, 60% could be losers. Okay, 40% could be winners, but the criteria would be you're risking 1 to make 3. If you follow that, do not snatch the profits, you manage the trade well, cut the losses, you will win. But then by fine-tuning your knowledge, that 40% can start to increase. So there's no rocket science in trading. Key is you need to be disciplined, you need to have mental fitness, you've got to cut the losses, you've got to let the winners run. And that is how we are able to do a whole day live in person trading seminars. Yeah, to do that, you need to have guts. To do that, you've got to have mental fitness. To do that, you've got to have a proper trading system. Yeah. Okay, so that's briefly about Bindle FX. If anybody is interested, that's our email, that's our phone number, and that's the website. And what I'll do now is I'll jump into chart analysis. And here you should be able to see 6 charts. Are you able to see the charts?
Yes, well, I can. Yeah, I can see 8, in fact.
Yeah,
So,
brilliant.
yeah.
Okay, excellent. Okay, I mean, probably I got about 10, 15 minutes or so. So what I'll do is I'll go through half a dozen charts, and main ones I'll focus on is, say, GBP, USD, and US 30. And in between, if anybody wants me to have a look at any charts, we'll certainly do that. Okay, so let's just have a quick look at GBP USD. This is a very bearish looking chart for the past few days. And this is something where the Bindle FX system, we've been selling this. Okay, so at every pullback, I'm looking to sell. As simple as that, right? So what we have here is I can have intraday indicators, right? So right at the bottom, you see Bindle momentum intraday. So here, this is what I normally use for scalping. And then at the bottom, you have got the Bindle momentum swing trading, right? And this is my long term. And often if I do have all the bars in the same color, the probability is that much more higher that this could be a very, very, very strong trade there. In addition to that, what you also have is this unique proprietary color-coded horizontal lines, which are Bindle pivot points. And often they act on as a very good support or resistance level. So here, for example, initially the intraday went long, okay, but long-term charts are very bearish. So offering you a nice long for the intraday, but then it hits this very strong pivot point here. There is no momentum about this green pivot, then it is really telling me that this baby wants to go down. And then as soon as it gets below the ribbon, we can start to look for a short trade here, right? For swing trades, I often use the 30 minutes chart. And as you can see, it is a bearish looking chart. You are having a series of lower highs, lower highs, lower highs. Look, the price is going down, crashing down. Here is not time to buy. For me to buy, the prices needs to create a very good 1, 2, 3 setup above any of these pivot points. Yeah, so these pivots needs to break to the upside. Okay, this pivots needs to break to the upside, and then the momentum indicators here needs to change color from red to green. So as soon as that happens, bang, you know, we'll be looking to take a long trade there. Now, if I look at 4 hourly, sorry.
I'm just going to interrupt you for a second here because it's 5 to 1 now. We ran into your time a little bit at the start. I've arranged with Alpesh to push his start time back to 1:15, which he says is fine because that still gives him 45 minutes, which is enough time for his presentation. So just to let you know that you've got that extra 10 minutes or so to run over in case you're thinking, how am I going to finish all this by 1 o'clock?
Brilliant. Okay, fine. So I'll take my time then.
Just got a little bit of an escape valve. I could just sense that you were trying to speed up and go faster than you originally. So there we go. I'll hand back. Thanks.
That's fine. Hey, Alpesh, thank you very much. Okay, now that's fine. So I'll slow down a bit, and then I can go through in that much more detail, and happy to take any questions, and also allows me to look at few other charts as well. Yeah. So here, GBP USD on a 4 hourly chart. This is really, as I said earlier on, a bearish looking chart. It wouldn't surprise me if we see a move all the way back down to the previous lows here. Yeah. So this is not a chart which I'm looking to go long. Okay. I'm looking to short at every up move, at every 1, 2, 3s. Of course, intraday, I may be looking for scalps because let's say when the prices come down, it's doing a pullback retracement back to those pivot points, then straight away I'll be looking for a short trade there. Yeah. Sorry, a long for intraday, and then as soon as it gets to the pivots, I'm looking to short the market, right? So this is one chart which can go on your watch list for a really nice short. Okay, it's already been a short trade, right? And this could turn out to be a mother of all shorts, right? Key point here, what I'm really looking for is it's already created a nice 1, 2, 3 below the yellow pivot. Earlier on, it created a nice 1, 2, 3 below the green pivot. So what is a 1, 2, 3? No rocket science, right? All it is, it's a pullback. It's a retracement. That's your 1. That's your 2. That's your 3. Yeah. The retracement from 0.2 to 0.3. Again, I don't need to use fancy indicators. You know, when you are focusing on lots of chart analysis, and with that experience, you know that, look, this is about 70% pullback. Yeah. And the key is that I'm always looking for minimum has to be 50% 1 to 3 retracement pullback. Okay. Some of you would be using your Fibonacci tools. Yeah. But if you can get over 70%, and even if you get 100%, so much so better. Yeah. And that's the key. It becomes a low risk, high probability trade. A failure at those pivot points, down she goes, pull back, down she goes, pull back here again. And as you can see, a really nice resistance at the yellow pivot, and down she goes. So what next is if one is not in, then I'm looking for a pullback, because what you don't want to do is you don't want to short it far away from the trigger. Okay, far away from the trigger or far away from the pivot points, right? The entry must be precise. Okay, yes, everything here is looking bearish. Yes, it is red. But look, if supposing somebody shorts when it's already moved 100 pips, then what happens is that when the pullback happens, you panic, right? So you really got to be so patient, so patient. The entry must be precise, right? It must be precise. So one of the tools which I use is I personally am not a breakout trader. I don't trade breakouts. From my experience of 40 years of trading, I see often those breakouts, right, tends to be fake breakout, right? And how can you know it's a fake breakout? Normally when you get failures, right? So here it broke the green pivot, but there's no momentum, right? So when it breaks those pivots, one of the things what I want to do is I want to wait for a pullback. So that was a resistance broke, went up. I need that resistance now to become a support. Okay, simple, no rocket science. I want that resistance break to become a support, and if that happens, fine, I take a trade. If that doesn't happen, again, fine, I take a short. If this happens, I take a long. If it doesn't happen, I take a short, right? So the key as a trader is I am not biased in one direction, right? I don't care whether the market goes up. I don't care whether the market goes down. So long as there is a movement. I don't care if, let's say, the FTSE ends at 7,000. I don't care if the FTSE ends at 3,000. No, I don't care at all, right? The key is there must be a movement. And so long as there's a movement, I've got a system in place and I take a trade according to my system. So here, what I would be looking for is I would have looked for a long at this point. So the resistance break did not become a support, no long trade. Prices went below that resistance. So it's still a resistance, a short trade there, okay? Another golden opportunity here. Obviously, this was a fast move. Again, that's one thing. What I don't do is chase long candles, okay? I don't chase long candles. Now, this is another opportunity right up to the yellow pivot, okay? Right, the other chart which I really want to look at is the US 30. As you saw this week, it crashed heavily, right? Well over 1,000 pips or so, yeah? Intraday, this is something which I've been shorting, right? My system tells me when to take a trade. Okay, so here yesterday, for example, you had some long opportunities, right? I didn't have momentum about that green pivot. So what do? Is I cut my losses, right? Of course, I will have losing trade. Of course, I will not get 100%. I will not get 90%. Even if I get 50%, but if I keep those losses tiny, but the winners monstrous, right? 600 pips here. Okay, look at that signal here, the Bindle FX issued there. Okay, nice orderly move there, right? Look at that, right? That was 700 pips. And again, if we look at the momentum indicators there, all sea of red, right? So right now is, apart from this one buy signal, it's been sell, 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 sell. Even this morning was looking for sales. So I'm not really looking to buy this. I think for US 30 that's my pivot one, red pivot. I would be really looking to wait for a price to break my yellow pivot or the aqua pivot. Yeah. So I would really want to see this happen, right? It goes up. So I'm going to be missing that move initial. Okay. Then I want it to come back down and then do that, right? I'm happy to miss that. 8 out of 10, you always get a pullback, don't you? Look at that. Price comes down, pullback, down, up, down, up. Okay, here again, down, I'm missing that, up. I'm getting here. Okay, up, down, up, down. See, prices don't move in one straight line, okay? It doesn't move like this, no. It goes up, down, up, down, up, down. Or for bullish, the opposite, right? So the key is my trading style is I don't go for breakouts. I wait for a pullback. If I don't get a pullback, I'm happy. I'll miss that trade. You see, I'm looking not at one or two charts. I'm looking at 30, 40 charts. So for example, I could be looking at GBP USD. I may not get a pullback, but you know what? I'll get a nice pullback on GBP JPY or GBP New Zealand or GBP CAD. Yeah. So look at many charts, but follow the system with discipline, right? That's the key. 4-hourly chart. Okay, look at that. 1, 2, 3, right there. And right now, it is at a critical level, right? It is at a critical level. It's below all my pivot points. It's below all my pivot points. It's below green, below yellow, below aqua, below red. A very bearish looking chart. And you know what? If this breaks, this too is going to be a mother of all shorts. It wouldn't surprise me if we get back to these lows here again. Yeah, I mean, I was looking at some of the US stocks yesterday, Apple, Facebook. I mean, that's creating a really nice bearish 1, 2, 3 setup. Not fully confirmed yet, but I reckon in the coming days, possibly next week, you know, it should be there for a potential mega moves. Yeah. So, you know, they are on my watch list. QQQ NASDAQ is on the watch list for a short, a really big short. You know, at the moment, the signal is short anyway, but if you're not in, wait for that pullback and ride that move. If you're already in, right, do not snatch that profit. Yeah, you're not gonna get rich by, you know, taking those 20, 30, 40 pips. No. Yeah, if you want that excitement, trading's not for you. You should be in Las Vegas, right? You will get rich by cutting those losses to 40, 50 pips, but those profits are gonna be monstrous. Yeah, so if you're short, I wouldn't take your profits, because if this breaks here, okay, it'll collapse. And you know what? One of the things, if you're not in, then make sure you don't go in on the break, because 8 out of 10 a pullback always happens. Yeah. Okay. This is what you'd be looking at. And once that happens, I tell you what, this could be worth thousands and thousands and thousands of pips. Okay. If there are any questions, obviously I don't want to eat up into Alpesh's time. So Simon, I'm happy to take any questions.
Okay, fantastic. Jay, do you always trade the same time frames, or do you vary? Is it...
For my scalping, I'm often using my 1 minute chart, and often I'm also using 12-second charts as well. Yeah, yes, 12-second charts. You do tend to have some really amazing opportunities, especially, see, when the markets were crashing last month, right? I literally was using 12-second charts on US 30, right? And here we are. This is my 1 minute chart. Okay, so look at that, my 1 minute chart just today. Start of the day, a short signal there, another short, another short. So it's just been telling me to sell, sell, sell. And you know, even that 1 minute chart here, that's produced what, 170 pips from the last break of the pivot. From the start of the day, from here, that's been worth nearly 225 pips. So the system can work on anything. If I'm looking for swing trading, then I'm actually using price action from daily for hourly, and then using the 30-minute chart to enter, right? But obviously, if I have all the bars here as red, as it happened here, okay? So see, this is a very good tutorial. Everything here at red, big candle, and patiently wait for a pullback, get right close to the trigger, and then you take a trade here. So basically, for intraday and scalping, I use 1 minute and 5 minute. For swing trading, for entry, I use 30 minutes. Yeah.
Fantastic, thank you. And Gordon has just posted a question saying, do you use big amounts on those quick shorts?
It all depends on having confluences of indicators, right? Big amounts, yes. Start of the day, I never do big amounts, but as time goes by, once you got that profit buffer, then what you're doing is, yes, I would increase the size, but the big amounts doesn't necessarily mean it has to use very high leverage. Obviously, I will not risk anything more than 2%. But yeah, with profit buffer, right, I will go on and risk, let's say, 5%. Okay, so if the trade doesn't go my way, okay, I've lost 5%. Okay, I've got another day to fight the battle. But don't use big amounts just because, you know, the signal comes in. That signal could be wrong, and if it's wrong, you know, you get wiped out. Yeah.
What about the 1 minute charts? Ash is saying, where would you place the stops there?
Okay, the 1 minute chart, the entry has to be as close to the trigger or the pivots, right? So my stops is always going to be at 0.1 or 0.3. So in this particular case, that's my 0.1. That's the lowest point, 0.2 and 0.3. If I've got a nice pullback, then I really want to have stops placed here. Okay, if the pullback is less or around 50%, then my stop I'm gonna put at just about here. Okay, so my entry is there, my stop is gonna be here around 44 pips, and it has moved 160, so risking 1, and the signal's still short. So the way I go about is I take 2 lots, right? So TP1, TP2. So if my stop is, say, 50 pips, my TP1 target is 50 pips, okay? And then the TP2 becomes a free run, and then what I'm doing is I'm actually trailing the stop at the trigger, okay? And once the move is big and there is a big angle and separation between the trigger and the ribbon, then I would start moving the stops in between. And if the move is mega, then I could be placing the stops at the ribbon. You know, say, for example, if it got to, for example, like a green pivot, right, which is a very good reversal point. Yeah, so I use confluences of indicators to manage the trade, but the key is do not close the trade. This is what I often do with my trades, right? Majority of my trades get stopped out, okay, but not at a loss.
We'll need to start winding it up, Jay. I'm afraid we're already at quarter past. Sorry about that. Time just gets
no
away.
problem. Right. Okay. Thanks a lot.
Well, that's great.
Goodbye, everybody.
And thank you
Happy
for
trading, everyone. Yes.
Oh, right. Yes. Okay. So we're already done. That's great. Thank you, Jay. Thank you very much indeed for coming in and speaking to us today. And we'll certainly post details of these events you've got coming up as well in the next couple of weeks. So thanks again, and take care.
Thank you. Okay. Bye bye.
Okay. Thank you, Jay Lacani. Beg your pardon. Should be looking at my screen again. Here we are. We're just about to go into our third speaker. We're just going to go right along here because Alpesh has been very kind to give us an extra 15 minutes there because we were running a bit behind, but should be live now. Alpesh, good afternoon.
Hi, Simon. I hope you can hear my audio okay. For some reason, the audio I'm getting from you guys it makes you sound like Mickey Mouse, oddly enough.
Oh, well, some might say that's an improvement. I'm not sure. I hear you absolutely crystal clear, which is great.
I'm sort of making out what you're saying. I am assuming you are asking me to start and kick off straight away. Just let me know that you can hear me clearly.
Yeah, I can hear you, and also Ash has already said the audio is good, so I don't think we have a problem. But let's just keep the chat to a minimum then, and just go straight over to you, and let's get started. I can see a whole new set out of slides, and I'm quite excited to see what you've got to tell us today.
Fantastic. So I'm going to kick off. Like I said, I'm sort of guessing almost what you're saying. I apologize. It is definitely audio on my laptop. It's my day off, which is why I'm doing this now. Which is why I've not put the camera on. I dare not have you all see what I look like. What I'm going to talk about in this talk, slightly different to the sort of the trading stuff that I normally talk about. And the part of the reason for that is within the hedge fund we have both the trading side, and we set this all up back in 2005. We have we've been doing investing. I've been doing investment, since I was a kid. And more and more people are asking about investing. They keep saying, well, actually, they're worried about their pensions. They want to not just trade, but they want to have a longer term investment portfolio. And given that I've written so many books on the investing side, I thought, well, we're missing 50% of what the audience wants. So let me just kick off straight away with what I'm going to discuss today. And this sort of sums it up. Look, The FTSE and the Dow that you see on screen there, and the image is slightly blurred. It's not your fault. It's just when the screen was captured by me a while ago. And you'll notice that basically from February the 24th until March the 24th, the markets fell. So the question now that people have is, well, have we seen the last of it? Are there opportunities to double our money or triple it or whatever else, given that some of the stocks have fallen so much? And if there is, then why do I want to bust a gut trading when I can just buy, hold, and put my feet up? Equally, people are worried, hang on, maybe some of the things that fell for a good reason. They were rubbish. And also, maybe we've not seen the lows yet. So what I want to share in this webinar is some of the data, what some of the biggest banks are telling their wealthiest clients, what's coming out of Goldman's, the kind of stuff we see as a hedge fund crossing our desk all the time. Some of it becomes a self-fulfilling prophecy, because if you're a JP Morgan or a PIMCO or a Goldman's and you're telling your wealthiest clients this stuff and you're moving your funds accordingly, it becomes self-fulfilling, okay? And of course, none of the big banks want to be left looking stupid, and certainly don't want to be losing some of their wealthy clients. So they've got to be a bit cautious. So what do we do whether the markets continue rising or whether they're falling? And that's some of the issues I want to address. And what are the kinds of returns we might be able to get, as I said, without busting a gut and being screen slaves just on the trading side alone. So we're just looking at the buy, hold opportunities, maybe for our SIP, our ISAs, and the like. I've got a message. Yep, good. I've got a message from Simon on my phone saying he can hear me, so that's good news. And really, to some extent, the issue that I am addressing is this. I mean, that's Merck. It's something which I bought. If some of you have been following me on Facebook or LinkedIn, you will know that I bought this when the markets tanked. And not because I'd normally buy Merck, but because I was looking for some quality stocks. And the fear is that what if this continues lower? And the market goes and retests it. So all my gains would be erased. So what do we do? If you're sitting on some gains, you're worried that they might be erased. What do? Do you cash in? And what if the market continues rising? So we need a strategy for both scenarios. And what I put together was the data as of earlier today. I put this data together in terms of what we can see some of the rises since March the 24th, when the markets bottomed out, and the falls that happened from basically the 20th, 21st of March, 21st of February until the 24th of March. So as I said, the markets tanked for a month from, call it the 20th of Feb to the 20th of March. This is how much they fell. You can see in red some of the exchange traded funds, and you can see the rises since. So the question now becomes, what's going to happen? How do you position yourselves? I mean, wouldn't it be nice to get a time machine? Maybe there's going to be a time machine for us to jump into if the market's at a low and get these returns again, which we've achieved in, say, 6 months, if you were in these instruments. And I'll tell you which of these I own. You'll know if you were at my Hammersmith talk back in March at Hammersmith Novotel, which one of these I own, but I'll come to that in a second. Equally here, putting it in these terms, we can't just blindly dive into these just because if the market goes back to where it was at the bottom of March, retests it lows, we might have a thesis that yes, it's going to gradually, slowly resume back, maybe even take a year. Well, I don't mind getting 100% return in a year if it falls back to where it was last March. But how sure am I of that? How willing am I to take that risk? Are there other things I should look at beyond just how much it's fallen? And mind you, 100% for doing nothing, buying and holding, seems rather attractive when you consider that if you're trading, you're having to work a lot harder for it. So which of these might now look attractive to me on that thesis? And what other strategies do we have? And what if the markets, as I said, keep rising? So we've got some interesting numbers here. We've got some potential timelines, but we need more of a strategy than just a load of statistics. So that's what I'm going to cover in this. Just to give you a bit of background on me, in case you don't know who I am, we run institutional funds. In other words, our clients are all institutions, not retail clients. These are some of our private equity and hedge funds that we have. Our bankers are Rothschilds, Waters, Ernst & Young, Allen & Overy, all of the rest of it. I set this up in 2004 with myself and my team. We have bases in Singapore, not that we're going to visit that anytime soon. and in Luxembourg, but we're a British company. I am proud to say a British asset manager. We don't have retail clients. I have no conflict of interest in anything I'm going to tell you, because I am not looking for you to become investors in our fund unless you happen to be a sovereign wealth fund on this webinar. So if you are the sovereign wealth fund of Singapore or Norway, you're more than welcome to join into our fund. I'm going to give you some of the knowledge I've got, not just as a regulated hedge fund manager. The thing about this industry is if you're any good at what you do, you get found. People will find you, they will get hold of you, and they will say, here's a shed load of capital, run it. Before I was doing the hedge fund stuff, I wasn't born with a silver spoon in my mouth. So before I was doing the whole hedge fund thing, I was a private investor, and I was writing in the Financial Times. I've known Simon for about 20 odd years now, at least 20 years more. I was speaking to retail clients such as yourselves, and I continue doing it. I love it because you get more, well, you get better feedback than you do from sovereign wealth funds anyway. And you might recall my columns in the FT, over 200 done. So everything in this webinar is going to be sourced from published information. It's been due diligence. This is not somebody sitting at home and coming up with crazy ideas which have never been tested, proven, or even liked by their peers. Okay, we're talking about things which have been tried, tested, published, and published in the most difficult of publications like the FT. Got it? You don't need to know that one. What you didn't need to know is this. The Dow over the last 100 years, I'm going to start off with the American markets. The UK ones pretty much mirror some of what I'm going to say in any event. Whenever we've had these big falls, we've often had massive rises the year ahead. Okay, 1 year change has often been up. So we do want to be looking at this opportunity. It is a once in a lifetime opportunity. It is an opportunity to get more return on our time by buying and holding, especially if you've seen your SIP plunge 30% in the last few weeks because you're with dodgy fund managers, of which I will talk more about in a second. Okay, and we want to have our low, medium, and high risk pots. How do we decide what goes into what? Given that some of the returns are ridiculous at the moment. I mean, we're not talking momentum trading here. We're talking when we're looking to just invest, you've got ridiculous returns such as Twilio, company whose services I use, up 66%. Overpriced Wayfair, overpriced as in their products, not necessarily their share price. PayPal, which I have a little bit of money in. Shopify's been going absolutely nuts. Anyway, that's 7 days. But how do we decide whether these are already overpriced, and what if the market falls? Those are the two big questions. What if it's already overpriced, and what if the market falls? Okay, because as I said, there are and one of the reasons I like American equities, and I'm going to talk about UK as well, don't worry, and global and Chinese ones and British and European ones in this webinar, and how to easily access all of that. But when we see returns like this, triple digit returns like this, we do think to ourselves, well, look, maybe it's not so much a needle in a haystack. Maybe we're not just looking at the haystack at all. And what I've written in the Financial Times in the past is that UK investors, of which I'm pretty sure everybody on here is from the UK, tend to be investing only in British companies. Now, the very first column I wrote in the FT back in 1999, the very first sentence to that very first column was, I am selling all my British holdings and buying only American ones. You can look it up in the British Library or at the FT. That's what I wrote. And you might ask me, so since 1999, how's that worked out for you? Well, it doesn't take a genius to work out just how well the American markets have done compared to the British ones. I'm not saying we don't own British stocks. I think it's the most patriotic thing in the world to do, to own American companies if you're British, because you've got Americans working for you and paying you rent and the kinds of returns they generate. Well, let me put it this way. Apple and Microsoft's market cap is equal to all of the 100 largest British listed companies. So the FTSE 100 in market cap equals Apple and Microsoft. Yeah, so it gives you some idea of the kind of growth and why I look at global companies. And I also, through the US markets, and I hold some UK stocks, I'll tell you what those are, Chinese companies, some of the biggest companies in the world, because they're listed on the New York Stock Exchange. So how do we access those? And it's good for, not just for my growth, for my portfolio for the long term and the SIP, and for my child's ISA as well, but it's also good for my diversification, because guess what? I'm already committed to the UK economy because I live here. So I better diversify by getting my hands on some global equities instead. Join me on LinkedIn, by the way, just as an aside. Join me on LinkedIn. I'm on there. It's free, of course, and you will see not just in terms of what I do in the hedge fund industry and private equity. By the way, it's one of the best ways to do due diligence on anybody. There's a lot of people on the internet. LinkedIn is a bit like blockchain for CVs. In other words, it has so many independent connections to it. You can very quickly judge somebody's credentials, because they can't be faked on LinkedIn, because their connections can't be faked, because the connections are real people. You know, if you've got the CEO of Barclays Bank who's connected to you, there'll be a reason for it, and 50 others like that. So anyway, if you want to do due diligence of people on the internet, look at LinkedIn, and I'm on there. Okay, so I highly recommend you do it. Now, let's get on to the discipline process. People are confused. There's a lot of problems when it comes to investing. I'm going to solve some of them for you. What I'm going to go across with you in this webinar is this. You come up with a whole load of names. It might be articles, it might be in the media, it might be social media, it could be WhatsApp, could be all sorts of things. It goes into your funnel. We're going to look at 7 quick strategies. I know 7 sounds a lot. Don't worry, it's not. I'm going to give you an overview. We're going to go through them. There's a little checklist for each one. And the more these stocks come into more of the strategies, the safer we'll feel. We'll then just get the right data from some of the right tools, and we will then buy, hold, or sell. Okay, that's what it's going to be. And it's going to be domestic stocks, exchange traded funds, in other words, index trackers, which might be country specific. They might be sector specific. But I'll come into that in a second. And as I said, global and US stocks as well. What we're going to do is divide all our holdings into either quality companies, the likes of Microsoft, Amazon, a bit more low risk, and I'll explain what those are in a second, or performance. Performance means you've got either a time target or a price target, okay, and or a price target. So you might say it's going to double in 12 months. That's a performance related stock. It's not the kind you're going to hold forever. That's all we're interested in. Performance related stocks will have stop losses depending on the strategy, and we'll go through this. This helps organize your thoughts. That's all this is there for. Okay, I'm going through it at quite a speed, but don't worry, it'll be recapped later. And the ambition, ultimate ambition for all of these funnels and simplicities and processes is because we want to get a return, the kind of returns that I want to do for people I work with, people I deal with. Very simple. I want them to go from their existing holdings, and I want to make millionaires out of them over a 10-year period. Now, if they're already millionaires, what I mean is I want to convert their 100K into a million, or their 10K into 100K. And I'll give you the maths on this in a second. And essentially, we're looking to generate for them a very modest. When I say we, they're doing it themselves. I'm not managing their money. I'm talking about me, what I want for you guys from what I'm teaching you. What I want for you guys is to hit a modest 20% per annum. Now you might think, well, that's not modest, that's bloody difficult. It's difficult for a long-only fund manager like a Neil Woodford because they've got so much capital under management. There's only about 10 stocks they can buy without taking over the company. It's very difficult for long-only fund managers. In the industry, there is a hierarchy. In my industry, there's a hierarchy. Right at the bottom are the financial journalists, okay? I mean, you know, they're journalists. They're not exactly fund managers, are they? Then above them is the brokers. The brokers, you know, they tell you stock picks. Well, there's a reason they're working at a brokerage firm and not running their own fund. Then there's the long-only fund managers. They're the kind of guys like Neil Woodford. They'll send me their CV and we'll reject them. You know, I mean, come on, they've got a one-way bet. The market's going to go up, and most years the market does tend to go up, and yet they get paid big bucks for that. And you know, Woodford's one example of that. So you know, we look down on them. I'm sorry, we do. The hedge fund guys, we're the sort of, if I may say so, the SAS. I mean, if you looked at my body, you'd think, no, you're not, but yes, we are. We're the elite. All right. So what I want for you guys is to try and get those returns, because you've got more choice of equities you can invest in, because you're not bloated with billions to manage and very few stocks to pick from. Okay, and the kinds of things we're going to pick on that you're going to have opportunity to pick on, we'll look at in a second. All right, now, like I've said, the market's going to do one of two things. So let's simplify. Throughout my career, I've been very privileged to meet many billionaires, and I guess one thing they've got in common is they have the ability to simplify the complex. So let me try and simplify for you. The market's going to go up or down. If they go up, your quality stocks, you'd probably buy more because you're planning to hold forever anyway. Okay, so we need to know which are the quality stocks. If it goes up and you've got performance stocks, they'll either hit your target or they'll hit your time period by which it was supposed to hit your price target, in which case you'll then revalue to see, is it in one of the 7 strategies? If not, you get out of it. If it is, then you start afresh with those performance stocks. Or the market falls. If it's a quality stock, you do what Warren Buffett said when asked what would you do if Apple falls 20%? He said, I'd buy more. Well, because that's a quality stock for him, and we'll work out what is quality in a second. Or if it's a performance stock, you'll say, well, it's gone down. It's supposed to be a performance stock. It's been 12 months, hasn't hit the target, time's run out. Is it still in one of the strategies? No, well, time to get rid. Or it'll hit your stop loss sooner, and we'll work out what a stop loss is as well. So we're simplifying this whole process for you. And I'm going to use some of the advice I've got from people from my 18 odd books. So like I said, don't trust me, trust the people I've got my advice and training from, people like Bill Lipschutz, who was global head of trading at Salomon Brothers when I met him, and his boss was one Warren Buffett. It's all been published in my book. It's not a plug for my book. I get £1 in royalties, and it's 20 years old. I wrote the book so I could meet the world's leading people in investment management, because I wanted to be an investment manager when I was training to be a barrister, because I soon realized I didn't actually want to be a lawyer. I want to be even more hated than a lawyer. So I decided I'd become a hedge fund manager. Very quickly, I'm going to name some stocks for you in a second. What this says is, please don't copy my slides. Happens so often. And please don't, just because I'm going to mention a stock I own, it doesn't mean it's financial advice for you to go out and buy it, because I don't know your personal circumstances. I'm not giving you one-to-one information is what I'm saying. Please leave now if you want to gamble and try and double your money in a week. This is not for you. Nowhere on the internet is for you. Okay, so please just leave. Actually, there's no point even trying to persuade you otherwise. This is where we are. This is where we are in the last month. Okay, so in the last month, this is what has happened. What has happened? The Nasdaq's already up 10%. The Dow's fairly flat, and so's the FTSE. So we seem to have stabilized, but you've made 10% just off the Nasdaq, let alone year to date. What coronavirus? The Nasdaq's up 3%. Yes, the UK markets are down 30%. Oh, guaranteed, my friends. Anytime the US markets are down, the British markets will be down even more. I'm not talking down the country. And if the US markets are up, the UK markets will be up even less. Guaranteed. It's just the way it is. We need to do something about that, but that's a bigger problem to be solved at some other time. But for us, I want to make sure, like I said, in 1999, that I'm heavily skewed towards global and American equities. Okay, and we'll talk about global equities as well. I know some of you will say, what about Vietnamese companies? Don't worry, we'll get to that. Now, so like I said, the Nasdaq's already erased its 2020 losses. So we need to get on this, because there's a lot of FOMO, there's a lot of fear of missing out going on, and now there's questions of, well, is it going to fall back? In which case, do I still stay on the sidelines, or is it going to continue rocketing ahead, or have I missed the boat? What the hell's going on? Okay, don't worry about that slide. Some slides I'm going to jump through in a second. 1 month performance of some of the biggest global companies. This is it. Now, every single one of these companies is not just a big global company like Alibaba, okay, but they all happen to be just as easy to buy through Barclays stockbrokers, or Halifax stockbrokers, or AJ Bell, or Hargreaves, or any other British stockbroker, for the very simple reason they're all listed on the New York Stock Exchange. They are what's called ADRs, American Depository Receipts. So when I want global coverage, I do my analysis not just to include the FTSE 350 and the small cap, or God forbid AIM, but I also not just include US equities, I include global ones as well, for obvious reasons. Now, we still need to know which of these might I want to pick, especially if we're looking to maybe, if something's fallen 50% since February the 20th, then we double our money if it goes back to where it was, even if it takes a year. I don't mind doubling my money in a year, let alone as some things have fallen 90% in the last, since February. If it gets back to where it was, even if it takes 3 years, I get a tenfold return on my money. Well, what are these glorious names? And maybe they fell 90% for a reason. So let's sift through. First thing we need to know is know what to look for. Okay, and by the way, speaking of some crazy returns in just the past month, this is the map of the US companies and which have done what. Okay, and I'll tell you which of these I own and which I've missed. And you know, it happens, you miss some. Okay, and some you've accidentally gotten done well, and that's perfectly fine as well. So we'll go through some of this, but you can see there's money to be made out there. So how do we get a proper, decent process so we can do it quickly and put our feet up for hopefully 12 months and just have our 100% returns, let alone 20% returns? Okay, and the reason some of these things have been going up, well, this is from the IMF. This is the IMF. We're not talking some ignorant institution, they reckon GDP next year, UK up 4%. US up 4.7%. US has not seen GDP growth like that since I think the Second World War. China nearing 10%. That's a dream for those guys. India at over 7. They've been trying to get to 10 for ages, let alone hit 7. So you can sort of see why and where this is coming from and what the beliefs are. But we need to get from here to there, first of all, and we need to make sure that we don't miss it by picking the bloody wrong things, which is, in my experience, 90% of private investors don't end up with quality or performance stocks. They think they do. What they end up is with poor performance stocks, poor quality stocks, and that part of their portfolio gets bigger and bigger as the losses get bigger, and they sell the profitable ones to feed the ever hungry monster, which is the bad performing stocks. In the end, all they're left with is a bag of trash and some tears. And why do I think there is the danger that we do have to protect against the markets falling? Well, how often in the last 100 years has the S&P 500 retested bear market lows? So in this case, bear market lows of March. Well, it's happened. And if you followed me on my Telegram channel or LinkedIn, you'll have seen I've mentioned that I think there's still a 60% probability we retest our lows and a 40% probability that we won't, and it'll continue going up. So I need to make sure my investments are working for me either way. If we retest lows, I need to make sure that I'm still making money and that I'll have some cash left to buy in. And if we don't retest the lows, it continues going up, that I'm still making money, I'm still exposed sufficiently in the market to make cash as well. So how do we do that? That's what I'm going to work on. By the way, the end goal, let me put it this way: assume you plan to invest over 10 years. That's a really look long term, because after all, whether it's trading or investing, you want to make money. That's all you care about. Okay, that's what we care about. And you, with my help, let's say from what I'm going to tell you in this webinar, can help you get to 20%. Now, don't forget, the market's going to deliver a large chunk of that. So I'm not actually trying to be too much of a genius here, all right? And 20% isn't that big a deal for a private investor, given that they've got more choice than the rubbishy fund managers have, right? Some years you'll make more, and I'm sure some of you have. Some years you'll make less, I'm sure some of you have. Nothing extravagant, nothing pessimistic. Let's say you've got 100K in your SIP or ISA, and you plan to add 1,500 each month. Now, some of you are going to say, Alpesh, whoa, 100K, who are you talking to? Don't worry, I'll come to more modest figures in a second. See how that works out. Well, by the end of 10 years, you'll have $1 million. That's the maths of it. That's not me. That's just the maths. That's not me saying, hey, look, I'm going to make you. My ambition is to make sure we get more and more people to these numbers. Why? Because, well, that's wealth creation, and that's good for the economy because it's good for you. And that's what the chart looks like. Simple as that, right? And those are your contributions in whatever color that is, teal, and that's where you end up with $1 million in 10 years. But that 20%, that's the difficult one. Okay, so this is what my 7 strategies are there for, and don't rely on the strategies, rely on the logic underlying them. But let's assume you're more modest. Let's say you're in your 20s, 30s, or you live in London, you've only got 10K in savings, okay? And you plan to add 6,000 a year, maybe £500 a month. Equally, now you might not have this today, it might be in a year's time, might be in 2 years' time. Let's at least have the education today. That should be invaluable for whenever you do have the money. Well, this is what your returns would look like with my help. This is what they'd look like. And when I say my help, I mean what I'm teaching on this webinar. I'm not going to run your funds for you. I'm talking about what I'm teaching on this webinar. And we're going to elongate the time frame because you've got less money to start off with, so presumably you might be a bit younger. So we'll say in 15 years you'll get to about $500,000. Whether it was pounds you started with or dollars, the numbers are, you just change the whether dollars into pounds, which depending what currency you were working in. Okay, that's where it gets to. So we've got a motivation. We've got one hell of a motivation to get there. Okay, we've got one hell of a motivation that I've set up. So what is it? Well, let me give you some insights. This is my son's junior ISA. He was born in 2018. You can only put 4,000 into an ISA anyway. So, it's not like the boy's about to retire at the age of 2. But in any event, from the things I'm telling you, he's already well above his 20% per annum return. Okay, he's well, not well above, but he's above his 20% per annum. It is something which is doable. Why has he only got 4 stocks? Well, he can only put 4K per annum in anyway. We've got quality in Apple and Amazon, and we've got Globant for performance, and we've got a bit of Premier Oil for performance. That was just bought more recently because of the oil price and what I expect it to do. I'll come to that in a second. So what are the problems in investing now? What are my solutions? What are the stocks I, Goldman Sachs, and Warren Buffett love for 100 to 500% returns. 500% sounds a stupid number to say. Well, actually, it's not me saying it, it's the blooming market saying it. From some of the things we've seen, it is once in a generation, the opportunity we have at the moment. Okay, so let's go through it. The biggest problems you have at the moment is most people pick stocks like a hoarding panic buyer. This is how they pick stocks, right? They get duplicates of stuff, they get a load of stuff they don't need, stuff they don't want, and most of it ends up in the toilet. Okay, they don't know when to let go. This is how most people deal with stocks. Right, they don't know when to let go until the stock is just reeking like a dead body in the corner. Like I said, we've only got two things to decide. Market's going to go up or down. We need to know which are our quality stocks, which are our performance stocks. For performance stocks, does it hit the target or does time run out? Right, whether the market falls or rises. And after a period of time, if it's a quality stock which is still up, we'll buy some more because we're holding it forever. This is the difficult one. It's the performance stock. It's either hit your target or time has run out. And then we decide, is it in one of our 7 strategies or not? If it's low quality, you shouldn't be owning it anyway. Please don't come to me with all your low quality rubbish and say, what do you think of this rubbish I bought? It's causing me lots of pain and it's really bad. I'm not in the refuse business. Okay. All the market's fallen, same thing. Quality, you'll buy some more. Performance, you'll hold. You won't ever buy more if it's fallen because it's a performance stock. You don't add to your losing performance stocks. Simple rule number 1 if you want to try and make money and get rich. Okay, and low quality ones, well, you shouldn't have owned it anyway. Sorry, here's some Kleenex. Okay, and then we go over here, same kind of story. Time continues, it's still underwater. Well, quality stock, you buy some more. So we need to know in the 7 strategies, how do we get the quality? Performance, same issue, you hold. Low quality, I told you, you shouldn't have owned it to begin with. Give it to charity, I'm afraid. Now, problem 1A, rubbish fund managers. This is another problem we've got to overcome. You can beat overpaid fund managers. The point of this webinar is I want you to be fund managers. If you've been reading my columns for the last 20 years, been watching my show on Bloomberg for the last 20 odd years, you will know this is not a new thing I'm saying. If you've read any of my 18 books, you know I've been saying you, the private investor, can be a fund manager, an overpaid fund manager because you're paying yourself, right? How do I know this? Well, I thought I'll put my money where my mouth is, and I bloody well proved it, right? This is me. I've said it before. Patel, top 5100 forecast the markets over a 12-month period, and there's Neil Woodford, narrowly beat a bloody cat, the editor's cat. The editor's cat was in that competition to see and try and humiliate people like Mr. Woodford. Mr. Woodford is beyond humiliation. In 2017, eventually, the rest of the world found out what we did, and I blame people like Hargreaves Lansdowne who are pumping money into him, and private investors who go by name recognition and I guess bulky, beefy good looks. Maybe that's why they didn't give me the billions, because of my double chins. I don't know. My point is, you can beat these crappy fund managers. Not only have people like me done it, but many private investors do it and can do it as well. Okay, and if you don't believe me, well, there you go. 99.4% of fund managers, we're talking long only fund managers, okay, not the elite like myself, which are hedge fund managers, if I say so myself. New York Times, right? That's the New York Times. That's research there. Don't have to worry about anything I'm saying. Just take the New York Times. By the way, the people who contributed to this article behind it, one of them then subsequently won the Nobel Prize in economics. Okay, fund managers without genuine. So I want you to be the fund manager. Stop sticking up for them. Stop saying, no, I've sunk so much money into a crappy fund manager, I've got to defend him. No, stop it. You should be the fund manager, and this is how we're going to do it. All right. Part of the problem is, of course, private investors are rubbish as well. The average private investor, this is their return. Effects of panic attacks on average investors. Well, 20 years of annualized returns since 1999 to 2018 for the average investor, 1.9%. That's according to Bloomberg, reliable source. So we need to improve your game. Okay. I mean, you know, the lesser of two evils is a rubbish fund manager, but how about we improve your game so you can beat them? Okay, now where to look? You don't know where to look. This is what most people are like. They're all over the shop on the internet and everything else. So we've got that issue. We don't know what to look for. Paralysis by analysis. This is fantastic information to a geek like me. It's a wet dream for a geek. But for you guys, you look, with anything in life, it all comes down to judgment. Anything in life, and judgment, whether you're marrying someone or marrying a stock, judgment always comes down to usually 5 pieces of data. Always 5 pieces of data in anything in life to make a judgment, and you need to know what those 5 pieces are, and they differ depending on what the issue is you're making a judgment on. This is my sister's portfolio. She asked me to give my views on it occasionally, and you got to weigh them. So what are the 5 pieces of judgment? What are the 5 pieces of information? How important are they? Everything else is guff. When you're interviewing somebody, is it really important what color shoes they have? You know, so we often get it wrong. So I'm going to tell you through the strategies what are the important pieces of information, how important they are, so you can quickly get on with finding the stocks and getting on with it. The other problem is expensive courses and subscriptions. It's my job to pay thousands each month to the various sources of information that I have. It's my job to pay $2,000 a bloody month to Bloomberg. And no, they don't give a discount just because you were a presenter there. And it's my job to pay those thousands, not yours. I'll give you the data in this webinar on what we found and what we've got, okay? Problem 5, you don't know who to trust. And when I say that, I mean this. I don't mean people on the internet. I'm talking about the bankers. This is S&P 2900. Guess what? Bank of America Merrill Lynch said it's going to drop 300 points by the end of the year. All right, this is the Wall Street's 2020 outlook. However, Deutsche Bank think it's going to be up about 350 points. Goldman Sachs, on the whole, think it's going to be up just slightly. Wait a minute, Bank of America Merrill Lynch down, Deutsche Bank up as much as Bank of America think it'll be down, and Goldman's are in the middle of the road. So you got 3 opinions there from 3 major banks. Yeah. Basically, it's not doesn't mean that these guys don't know anything, but it means, geez, you're pretty much hedging your bets with whoever you want to follow. JP Morgan up 3,400, even more bullish. My point is, look, I went to university with some of these guys. Okay, I lent money to some of the guys who work at these banks. Don't ignore it, leave it. If they were any good, they'd be running their own funds. All right, it's as simple as that. So given that I brought up the issue of trust, I'm going to suggest humbly, if I may, that maybe you want to trust me in this webinar. These companies pay me to speak to their audiences. Yes, Goldman Sachs pay me to speak to their audiences. The FT pay me to speak to their audience. Merrill Lynch, HSBC pay me to speak to their audiences. There's a reason for that. And Barclays, I'm fortunate if they do my book launches, and I'm giving all the data from everything that's been published. I'm not just picking it up. And my country pays me to find stocks for the UK. My job, as I'm one of the British government's deal makers, my job is to find high growth companies from around the world to bring them to the United Kingdom. And that's what I was doing with HRH over there as well. Okay, so I'm a stock picker for the UK government. Forget a fund. My country is $5 trillion economy. Okay, I've been doing that for 15 years. So let me tell you what problem 6 is. There's a rich poor divide. Therefore, there's a rich poor divide in information. Well, the information I get access to as a hedge fund manager, or I'm talking to when I write in the FT and been doing it for long enough, you don't necessarily have access to. So how do we level that playing field in the internet age when it should be leveled up? Okay, given that I get access to what Barclays is feeding trillions of dollars of money being held by people by giving them things like this, so I need to know, okay, what are they saying in terms of likelihood and impact of what's going to happen in the future, because it becomes a self-fulfilling prophecy at worst. At best, they're right, and it happens anyway. So how do we get that edge for ourselves? It's a problem you guys don't have access to that kind of rich data. You don't have access to research like this out of New York University. I'm going to give you their best picks. They did research on hedge funds and their best ideas, and they discovered hedge funds' best ideas are better than, way better than the best ideas of long-only fund managers, who are basically the kids who couldn't get a job at a hedge fund. So what are the picks they're saying? I'm going to give you those names, and I like those names that they've given as well, by the way. You don't get access to Goldman Sachs investing in 2020 and beyond reports. What the hell's Peter saying? Okay, so I'm going to give you those in a second as well, let alone Goldman Sachs's best and brightest ideas. They send them to us. They don't give them to you. So I want to be a bit of a Robin Hood, take this information and give it to you in this webinar, okay? Because guys, look at this. Why would I not share it? Some things have fallen 50%. If something's gone from 100 to 50 and it goes back to 100, you get to double your money. And like I said, it's gone down 90% in some cases. Well, let's hedge our bets a bit and see it's not just what we like, but Goldman's also telling people, or whoever, Rothschild's telling their people to put money in and becoming a self-fulfilling prophecy. If so, that alleviates some of the issues. On top of that is which broker. People don't know which ones to use. They don't have an inside mentor getting access to the information. As I said, that hedge fund research, the best ideas, stocks across hedge funds as at the end of 2019, and I've gone through all of it. And by the way, these hedge funds over $1 billion. We don't have $1 billion under management. You might say, well, I'll switch off now then, Alpesh. It's taken me 15 years and we've only got to 100 million euros under management. And you might say, well, you're rubbish. Why are we listening to you in your fund? Well, I intend to get to $1 billion in 10 years, but I do go in after Goldman Sachs and before Merrill Lynch. And usually people will give it to one or the other, or they'll probably give it to Neil Bloody Woodford. How's that worked out for you? I'm not bitter much. All of these I like, I don't have an issue with. I would put them at medium risk to generate a 30-40% return in 12 to 18 months. I don't have a problem with saying that. This is what Schroders are pumping to their clients. Okay, it's the FAMAGs. If you don't know what FAMAGs are, well, they're listed there. right? So that's doesn't still tell us which is quality. Each of these I put in the quality bar. I don't mind if they fall, I'll buy some more. I'm not going to stay out of the market waiting for them to fall first to get in. If the market falls, I'll buy some even more. But these are all performance related ones over here, even MasterCard. MasterCard, actually, I might put in the quality stage, but we still need a decent strategy where we put these into. So let's look at those strategies, which are based not just on my own analysis, but also on some of the stuff that's going out on Wall Street and I'm reading, and UBS. Okay, this guy, the chief investment officer, he and I read economics together at university, and I do like him. He's rather good actually for UBS. He's their chief investment officer. Okay, and guess what's happening? Well, the world's richest are waiting for a new dip in stocks, says UBS Global Wealth Management. So we better have some powder dry. And this is what Goldman Sachs says when the market moves up and then drops, it does rally, which is where we are now, but it tends to do this. So there is a 60% probability in my estimation of that, and I still need to be making money even if it falls. Okay, so let's look at those stocks now. The ones Goldman, Buffett, and myself saying that we like. So we're on part 2 of the webinar bit here. I've got 7 strategies. I've listed 6 there, but I've got 7 strategies. You don't have to use all of them. You can add or subtract as you wish. Let me run through them in outline. Number 1, which ones do the gurus hold? That's not in and of itself enough. I need to then see if it falls into any of the other strategies, but it gives me some comfort. Like I said, the gurus, well, some of the best hedge funds in the world, they're looking at these. That instantly went into my funnel of things I might want to look at. I then look to see if they fall into my other strategies, okay? Gurus, when I say that, it is my business to know, not just Buffett. I've given that example because you've all heard of him, but to be honest, Stephen Cohen, more important to me. Jim Simons, far more important to me than Warren Buffett in terms of what he owns, not least because the levels of their accuracy and also they're more akin to what you and I are trying to achieve, which is longer term holdings in a broad range of companies as opposed to just insurance arbitrages. So anyway, it's my business to know what they've bought, when they've bought it, and not because I'm going to buy into the same things, but because if it falls into one of the other strategies and they've got it as well, well, it tells me something, doesn't it? Okay, so like I said, with any names that I come up with, and they're either UK or global stocks or exchange traded funds, which strategy is it in? I then check the tools and software to see the data, because I need to know what to look for and how important it is, and then work out whether to buy, hold, or sell. So let's do some of that. Okay, investment strategy 2, leverage big on low risk. What do I mean by that? I leverage big on what I think is low risk. If it's low risk, I want to leverage it up to get to a medium to higher risk on it, because that's my profile. What I mean by that, that's the S&P 500 total return since 1926. Over the 100 years, the S&P 500, the US markets, tend to generate between 0 to over 20% in most years. So it's a positive return. Long-only fund managers get paid money to not even be able to beat this. Can you believe it? Best job in town. You get paid a shed load of money and you can't even beat the index. That's your long-only fund managers. No wonder we look down on them. Right, so I don't just buy the index track. I don't buy the S&P 500. What I do instead is I've got the triple leverage. Now, there's a risk to that, because although for every dollar the S&P goes up, $1 I make 3, I also lose $3 every dollar it falls. And if it just goes sideways, I will be losing money. So it's not for everybody. It is suited to me. You might just want the plain one, okay, the plain vanilla one. Anyway, there's an insight into my SIP. So not all my SIP stocks, just some of them. All right, and I'll tell you some others in a second. So Amazon was on the quality side, Inovio Pharmaceuticals was on performance, Apple on quality, Premier Oil on performance, Wisdom Tree sort of, well, I'd say quality, but it's triple leverage, so not suitable for everybody. 2 times Amazon exchange traded product. That means every dollar Amazon goes up, I make $2. That is there. And Tristel is also performance. Leverage shares again in Microsoft. Every dollar it goes up. This was in the past. What is that? Just recent past. Okay. Now. Investing strategy number 3, extra quality. I'm not actually going to go into this one. I look at exchange traded funds and see what they hold and what impact they're having in terms of quality, because some of these are just going up and up and up. But I'm not going to go into that in the interest of time, because I'm going to tell you some of the more interesting stuff. What are banks saying their richest clients? That's what a lot of people want to know. What banks tell their richest clients are their analyst forecasts. Okay. Now, normally, if you've read my FT columns, you'll know I consider those analyst forecasts rubbish, because the bankers are pretty rubbish. I consider them rubbish because they're usually out by about 20%. So great, you're out by 20%. However, right now, being out by 20% is no bad thing, because I can allow for you being out by 20%, and I can go from 6 to 10 and nearly double my money. Even if that takes a year, I got 100% return in Petrobras. Who? Well, Petrobras is actually Brazil's largest oil company, which is listed on the New York Stock Exchange. It's an American depository receipt. And not only that, this is what on average Wall Street analysts are telling their clients, their wealthiest clients, they expect the price to be, self-fulfilling prophecy. Okay, so I've got two elements of low risk, and it also happens to be a guru buy. Okay, Citigroup, similar kind of story. I'd look to make about a 50% return in 12 months or so from that. Comtech is another one. You can see the strategy that's been deployed. So I'm running through it a little bit quickly. There you go. Analysts say 134% to the upside. Not me. I'll say maybe 100%. I'll allow myself a year to 2 years, well over that 20% target that I'm trying to get. Disney was one for my sister. You saw her portfolio earlier. Sunina, I told her, well, she wanted some money for her, what she wanted to save rather for my nephews and nieces' school fees in the future. And I said, well, something a bit safer for her. Why? Because I tell you what, when I'm on the BBC talking stocks, I've got an audience of about 300 million people. That is nothing if you get it wrong. That is nothing compared to if you get it wrong for your sister. Okay, so she keeps me more diligent than all that audience. Anyway, this is the Uber figures, Viacom figures. I'm just running through a few now because I know we're short on time. Fox, okay, guru buy, falls in that strategy, also falls in what the big banks are telling their clients. What else are the big banks telling their clients? Well, they're telling them this little formula, believe it or not, developed in 1969. This formula, you don't need to read it. I'll tell you what numbers you need to look for. It works out whether companies have got working capital. You know what's really important during coronavirus? Working bloody capital, retained earnings. Retained earnings means how much money they've got in the bank, okay, which is what that's about. And we're sort of also looking at their assets. Basically, an Altman score above 3 means a very safe company. So before you take too much risk, check that number. You don't need to check it for a Microsoft, obviously, but for anything else, you might want to have a look. More importantly is this. Invented by Goldman Sachs. This is, sorry, invented by Deutsche Bank. This is a slide from Goldman Sachs Asset Management that I stole. And they use it to tell their wealthiest clients what to put their money in. And guess what it looks at? It looks at cash flow. Okay, and it looks at the ability to generate cash flow. Guess what's important right now, more than anything, which companies are getting rewarded? Those with good cash flow. I'm looking for croquis above 10%. Right, what are the numbers? Take a screenshot of this if you wish. You can see some croquis there. That's 10. Alpesh value growth rating, I won't go into that too much at the moment. That's at a 7. That's been up 61%. Okay, but the Altman's below 3, so I know that's a bit higher risk. All right, and there's a whole bunch there. You can take a picture and do the analysis, and that's for the NASDAQ 100. That's the data, and I'm telling you some of the data you should look at. You can do the analysis in your own time, okay? And similarly, more stuff over there. National Express, what was I thinking? Well, I was thinking discount cash flow. I won't go into discount cash flow again at the moment, but it's another way of measuring the present value of a company, the net present value of a company, again, because time's a bit slow. Lloyd's, my sister asked me to evaluate it. I said no, for a variety of reasons, mainly to do with the key things we should be looking at and how it's been performing. How many stocks should you have in a portfolio? I'm going to tell you 15. Why? Because risk pretty much gets leveled out around 15. You can have 20 if you wish. Don't have less than 10 ideally, because you're taking too much risk. Okay, and this is from Fidelity. If you're looking at an aggressive growth portfolio, and by the way, blue for US stock, just read stocks, and for everything else, the blues read stocks, whether it's US or foreign, and for green and yellow read cash. Don't worry about bonds and short-term investments, just read cash. Okay, so you've either got stocks or you've got cash. And the best 20-year return, the Fidelity annualized, is on an aggressive portfolio just shy of 20%. It's 16.5% if you're just tracking, right? If you're, I mean, this is just throwing darts at a dartboard, they're saying. So my job is to get you to 20, you know, get you an extra 3.5%. Yeah, not so difficult now, is it? I'm not going to go into investment strategy number 5. We'll do that on a separate webinar I'm doing for Simon on Monday, which I'll give you the link to in a second. Just again about cash flow and how undervalued something is based on its net present value. What we're looking at there in terms of stocks is basically what's it worth today. Given that in a year I might get 110, what should I be paying for it today? That's all it is, and that's how I picked National Express. And then I love playing around with tools like this. That's PayPal. What profit growth would it need to have to try and, given that the analyst forecast is 172, what kind of profit forecast would it need to have to try and get to kind of the numbers that I want? What's its current share price, and so on and so forth. Having said that, is it likely to hit that, given that last year it declined 15% in profits, and over the 5 years the average is 16.8? Maybe I want to play around with this and say, no, Alpesh, you're being over optimistic on PayPal. It's not a long-term quality stock. It is instead a performance related, momentum based one. Anyway, lots of tools like that. Investing strategy 6A, high returns, resuming returns. So there's only 2 more to go. This is high risk. What this is saying is, look, the market since February has risen. If it falls back, all these gains since the March bottom will evaporate. And if they were to come back, then that's how much you would make if they got back to where they are today. So you double your money in William Hill if all those gains evaporated and came back over, well, how long? A year, 2 years? And those are the same principle. This is a more higher risk strategy. It is the same principle with the exchange traded funds as well. But for this to work, you'd have to first wait for the market to hit to go at least as low as it was in March. In other words, these gains to evaporate, and then your strategy is they will resume back, even if it takes a year. After all, they did it in just a month. So maybe if even a year, so you give yourself ample opportunity, you'll be doubling your money in some of them. Okay. Similarly for NASDAQ, there's some of the data for you, and I've added the croquis as well. Take a picture if you wish. On that one, I won't go through French connection. Want big returns? What my wife said, I won't have a chance to do this. Basically, my wife said to me, I want big returns, don't bore me. I want to turn £1,000 into 3,000 in a year. I said, what you actually mean, sweetheart, is I want stocks with on average big returns with the least probability it misses them. That's what risk means. Least probability it misses them on average. Average probability miss them. Well, there's something that hedge funds use called Sortinos. The Sortino ratio and the Jensen Alpha, we use it. Long only fund managers don't, because they don't have the intellectual capacity to use it. Anyway, won't go into it, but in case you are interested in which out of the FTSE 350 have some of the some good Sortino, you want a Sortino above, well, 1 ideally, but preferably above 2, and an alpha as high as possible, basically in a value growth rating. You can look at that in your own time. So 7, some of the medium risk exchange traded funds. Again, not gonna have time to go into the exchange traded funds, but this is my universe that I want to pick from. I do want to have exposure, maybe not to individual stocks, but semiconductors in the US market. Well, that's higher risk because it's semiconductors, but I think I'm okay. That's why I own information technology exchange traded fund, a lot cheaper than giving my money to a fund manager, because these are not run by fund managers, so they're cheaper anyway. But that's my bet on information technology. Not exactly genius stuff, is it? Having said that, well, you know, I get to go from, what is it, in a couple of years, from 130 to 260 in, what's that, in 3 years. That's doubling your money in 3 years. That's not too bad. 33% on per annum on average in a diversified pool of stocks. Some more things I own. I told you Amazon. This was the crude oil bet, let's put it that way. I think crude oil is going to go back to $60. It might take 3 years. I don't care, because if it does, and I've got double leverage, I'll 6-fold return on my money. Apple I've got on double leverage. I've got the FTSE on double leverage because of the recent falls. These are some important numbers you don't need to worry about. I've sort of discussed it. What I will say is don't worry about that either. This is why people fail. Private investors don't know what to look at. They don't have a strategy. They add to their poor losers. They panic on profits, panic on losses. They have expensive subscriptions. They rely on journalists, I'm afraid, and brokers. They spend hours and get confused. That's what's bad. Enough about me. More fat me. Simon, I'm doing a webinar for Simon on Monday. Well, there's the dates. On Monday at 7 p.m. and on Tuesday at 1 p.m. That's the URL. I'll go into more detail because I'll have more time into everything that I've discussed today and update the picks and the slides and everything else. Okay, so I hope you will like all of that. Simon, over to you. I've overshot. I apologize.
Yeah, absolutely. Alpesh, I mean, it'd be fantastic to expand on all these things. I know you've gone through a lot of stuff in rapid fire today. Thank you for that. I mean, we're all guilty of getting sidetracked and lost in our bubble of MT4 platforms and buying and selling and moving averages and all the rest of it. I wonder what the difference in cost of trading is throughout the year compared to your strategy of turning yourself into a fund manager.
Oh, do you know what? I can't hear a word. I think there was something about trading and fund manager and strategies. It's my audio. It's not your fault. It's mine.
Yeah. I mean, I think that's if you can't hear me, then we'll just move on. But thank you very much indeed for that presentation, Alpesh. I think we're getting some great comments on the chat box as well to say thanks for that. We will keep everybody informed about the next events, the fuller events taking place on Monday and Tuesday as well next week. But in the meantime, I think with the sound issues, we're not going to be able to have a conversation about anything. But my thanks to you, Alpesh Patel, of course, always a great friend. Thank you very much indeed.
Thanks.
There we are. So I will take the presenter role back because that brings us up to the end of our working lunch for today. So rapid fire presentation from Alpesh Patel, preceded by Jay Lakhani talking about his Belle and FX system, who was preceded by Charlie Burton. So we made it there to the end. Gordon says we made it. Yeah, no more thunder and lightning here either. It's, the sun is coming out and everything is returning to calm. So thank you guys. It's been super having you here with me again every Thursday lunch. We do this working lunch now. It's great fun. I hope you're enjoying it. Jay's mental fitness coach, David, I will send details of that to you later this afternoon. In fact, I'll send links to Charlie's the full day event on Sunday that Charlie and Kim are doing at Easy Trader. Then online, I'll send you links for Jay's course, and of course, I'll send you links for Alpesh's fuller webinar on the Monday evening. Send that all in an email later this afternoon. So listen, super to have you all, and thank you very much, and you know, good luck with the trading, good luck with the lockdowns and the releasing from lockdowns wherever you are. I hope you're getting out and getting back to some sort of normality. So stay well, everybody. Thanks for joining us, and we'll keep in touch again as we move on. Many thanks again. Bye bye.